So, what is your perspective on the credit side of fintech, and especially the SME, MSME, the credit needs, addressing it through fintech? What's your view on that?
Right. Yeah, first of all, thank you, Vikrant, and thanks everybody for having us on this panel today. I just thought at the introduction just now, and when I heard about Samavesh and the meaning of Samavesh, which is inclusion, in many ways, fintech is playing a role of financial inclusion. Really, that's what fintech is actually driving when you actually peel through the layers. Because all this, it's not as though, I mean, to the point that Vikrant made about credit. Credit has been around, banks have been around giving money to, borrowers, small and big, for a very long time. Fintech is only playing that role now in actually making it easier, both from a transactional perspective. All these, on the consumer level, we've seen these apps come through. B2B is where the innovation still is work in progress. But really what fintech is doing is actually trying to get credit down to the smallest borrower, not only the consumer, but even the small vendor or the dealer, using a lot of technology, using a lot of data, etc. And I think there's a bunch of things which have happened, not only in India. India is leading the charge in many ways, but across the world as well. So just staying on that financial inclusion topic, if I were to just take the example that we just heard about Apollo Tires and United Phosphorus. Now, both of these entities are very well covered by the banking system. I mean, there is no need, or they've been around for forever. They're large companies, banks, throng to them to give them money. But then spare a thought for the vendor of each of these companies, or the sub-vendor, or on the other side, a dealer, distributor, and a retailer. Most banks only go out to the larger of these entities. They don't go lower, because on the face of it there is a credit quality issue. The smaller the entity, the more a bank thinks that there may be a credit issue. That is clearly one part of the story. There is another part, which is that getting to these smaller guys is actually difficult for banks, because the cost of of actually getting credit to them is very high. So I think fundamentally, when one thinks about financial inclusion, it's about really bringing down the cost of financing. If one can actually bring down the cost of financing, then automatically you are able to go out and push that lower cost into parts of that value chain who don't get formal financing today. So in the absence of financing from the banking system, it's each of these small dealers, vendors for that matter, it's not as though they're starved for credit. They do get money. They get money at onerous rates. They get it from the local money lender. They get it from sources which actually undermine their own businesses. What would it take for a large bank to go out to these small borrowers? And that's where I think a lot of platforms are playing this role in coming and bridging that gap by bringing in technology at one level. In some sense, a lot of banks have outdated technology. Fintechs are coming in and bringing in layers of technology that can actually make processes much simpler. And these could be at an operating level, this could be at documentation level. There are various parts to it. At quite another level, fintechs are playing a very important role in assessing credit differently. So historically, banks have been, for want of any other mode of lending money, especially to the smaller guys, banks have been seeking collateral as a base for giving money. You give me collateral and I'll give you a value, an equivalent value of money to you. Now, the small guys have only so much collateral. The small dealer, vendor, or the small borrower is limited by the amount of collateral he has, and therefore he can only provide so much collateral, get that much, that size of a loan, and therefore cannot grow his business beyond the kind of collateral that he already has. If there was a way to actually, evaluate his business basis the kind of the volume of business that he does, and not link it to collateral, that would change the paradigm. And that is something that is really taking shape right now, because suddenly what's happened is, with the advent of GST, for example, there is a view of every business's actual volume of business month on month. There's also data available right up to the previous month. There's banking, so there's something called the account aggregator framework, which is actually in play right now, and it's going to probably get better going forward. The idea is that in the account aggregator framework, banks will be able to share data about a customer, amongst themselves. So what this really does for the banking system is that they have richer sources of data, be it banking data, be it business data through GST, KYC, and such other things, which actually make it easier for a bank to evaluate these smaller customers and probably, actually cross that bridge and make that loan to them that they didn't in the past. I think these are all of the changes that are coming through, partly driven by the government, because many of these layers are being built by the government. And at another level, the fintechs are stepping in and finding ways to use these infrastructure layers to actually push the idea of financial inclusion. I think that's a big thing. So everyone talks about financial inclusion, about getting money to the smallest borrower. Actually, it goes one step beyond that. It's about getting money to the small borrower at an affordable cost. I think if one can actually solve for these two, we've actually fixed the problem.
Absolutely. Interesting.